Let's start this video with an example of two investors. Investor A has 10 lakh rupees in an equity fund and investor B has split his investments. He has 7.5 lakh in an equity fund and the remaining 2.5 lakh rupees in a debt fund that gives 6% returns. Now, can you guess their returns if markets fall by 15%? Well, investor A's corpus will be 8.5 lakh. That's straightforward. Surprisingly, the investor B will do better. His investments will be worth 9.03 lakh rupees despite investing in debt. This is the magic of asset allocation. It protects your investments when markets fall, and when they go up, you also benefit from the equity allocation. Now, this is exactly what aggressive hybrid funds do. These funds invest in both equity and debt and rebalance their portfolio periodically. Their equity allocations vary between 65% and 80%. And their debt allocations can range between 20% and 35%. Now, an equity allocation of more than 65% helps investors enjoy the benefits of equity taxation. Asset allocation with periodic rebalancing optimizes the returns and stabilizes the portfolio. So, we thought, why not look deeper into this category? So, we decided to compare the top 3 funds in this category. Hello and welcome to ET Money's YouTube channel. Today, we will compare SBI Equity Hybrid, ICICI Prudential Equity and Debt, and HDFC Hybrid Equity Funds. Together, they constitute approximately 62% of the AUM in the aggressive hybrid category. First, we will look at the investment styles of these funds. Then, we will compare their performance to see which fund performs the best. Now, there is going to be a lot of data and interesting insights in this video. So I recommend you watch this video till the end. But before we begin, a quick update. We have reviewed a lot of popular mutual funds. If you want to see our previous analysis, you can head to our playlist section and look for the collection called Reviewing the Best Mutual Funds. It has over 20 videos. I've also added the link in the description. Alright, let's start by looking at the investment styles of the 3 schemes. Now, to analyze the investment styles of the schemes, we looked at 3 parameters. First, their market cap allocation, then the portfolio turnover ratio, and finally the number of stocks. Now, by looking at these 3 parameters, you can get an idea about whether the fund is aggressive or conservative, and to some extent understand how the fund manager's style. Alright, let's start with market cap allocation. We will examine whether the fund manager prefers large caps, mid caps, or small caps. Now, how these funds distribute their equity allocation can affect performance. Now, ICICI Prudential Equity and Debt Fund is heaviest on the large caps. As of August 2024, it had allocated close to 59% to large cap stocks, while the category average was 49%. HDFC Hybrid Equity Fund had a large cap allocation of 47.3%, which was lower than the category average and the other 2 funds. SBI Equity Hybrid Fund is somewhere in between the 2. It has 52% allocation to large caps, slightly higher than the category average. Now, if we look at the allocation to mid caps, SBI's fund takes the lead. Its mid cap allocation stood at 18% as of August 2024. Historically too, the fund has mostly kept a mid cap allocation of more than 10%. The mid cap allocation for other 2 schemes stood below 4%. Lastly, we looked at the small cap allocation, and HDFC Hybrid Equity Fund has the highest allocation. As of August 2024, its small cap allocation was 16%. Now, that's quite high, and this has been the trend for HDFC's fund historically. Now, the other 2 funds had small cap allocations of less than 5%. So overall, ICICI Prudential Equity and Debt Fund is heavy on large caps. SBI Equity Hybrid and HDFC Hybrid Equity have higher allocation to mid and small cap stocks respectively. But what does this data tell us? Well, the market cap allocation tells us that ICICI's fund should have better stability, and the funds from HDFC and SBI should generate good returns with some volatility. Next, we looked at the portfolio turnover ratio of these funds. This metric tells us how frequently the fund manager buys and sells stocks. A ratio of more than 100 implies that all the stocks in the portfolio have changed over the past year. Now, HDFC's portfolio turnover ratio is 35.1. For ICICI and SBI, it's 32 and 50 respectively. Now, during the same period, the portfolio turnover ratio for the entire category was 90. So, none of the funds buy or sell stocks frequently in their portfolios. This shows fund managers have high conviction in the stocks they pick. Alright, we will now move to the last metric in this section. Now we'll look at the number of stocks to understand whether the fund has a concentrated or a diversified portfolio. If a fund holds a high number of stocks, then that implies that the fund manager has a well-diversified portfolio. On the other hand, if the fund has fewer stocks, it implies a more concentrated portfolio. Now, as of July, HDFC's fund had 39 stocks in its portfolio. SBI's fund had 32 and ICICI had 81 stocks. Now, of these three, ICICI Prudential Equity and Debt Fund has the highest number of stocks. This implies that ICICI's fund has a more diversified portfolio than the other two schemes. Now, if we look at the historical numbers, the trend is similar. ICICI had between 50 and 80 stocks, and the other two schemes had between 30 and 45 stocks. Now, this diversification in ICICI's portfolio can improve its downside protection. If some of the bets go wrong, it won't affect its portfolio significantly. On the other hand, SBI and HDFC both have a slightly concentrated portfolio. But as the number of stocks is lower than ICICI, they could be more volatile comparatively. Next, we looked at how these funds manage their debt allocation. Hybrid funds have significant debt investments ranging between 20 to 35%. If the debt is managed well, it can directly impact the fund's performance. Let's start with how much these funds allocate to debt. Now, for HDFC's fund, this allocation varied between 20 to 30%. For ICICI's scheme, it has mostly been around 20% consistently. For SBI, it varied from 20 to 27%. Now, while ICICI is more consistent, the other two are more tactical with their debt allocation. Now, typically, debt investments carry two types of risks: credit and interest rate. Now, debt investment is nothing but loans given to various companies and governments. A company can default on the loan repayment. This is credit risk, and it's more prominent in corporate bonds. Now, credit rating agencies evaluate every debt instrument and provide a rating. For long-term debt, a AAA rating means a very low chance of default. AA means low to moderate risk, and so on. And for the short term, it's A1, A2, and so on. Now, to assess the credit risk profile of these funds, we looked at where they have invested. For example, HDFC has allocated 18.89% of its debt towards corporate bonds. The remaining 6.88% is allocated to government securities. Now, HDFC has the highest allocation to corporate bonds. The other two schemes have close to 10% of their debt allocation towards corporates. Now, if we look at the credit ratings of the three funds, for HDFC, close to 16.5% of its corporate bonds are AAA rated. Around 2.3% are AA or lower. Now, even though it has high corporate bonds as part of its debt allocation, they are relatively safe. On the other hand, ICICI and SBI have a lower allocation to corporate bonds, but both hold a good percentage of AA rated debt instruments. Now, this increases the risk associated with their debt allocation. So, from a credit risk point of view, ICICI and SBI are slightly riskier than HDFC Aggressive Hybrid Fund. Next, let's look at their interest rate risk. Now, whenever RBI changes interest rates, bond prices get impacted. For example, if the central bank lowers rates, bond prices go up, and if it increases rates, bond prices fall. Now, the longer the duration of the bond, the higher the impact. That's why government bonds are more sensitive to the interest rate change. The tenure of corporate bonds is usually short to medium. Now, to evaluate the interest rate risk, we will look at the metric called modified duration. We will not get into technicalities here, but simply put, this metric tells us about interest rate sensitivity of an instrument. A higher modified duration means a higher interest rate risk, while a lower modified duration means a lower interest rate risk. Now, if you look at these three schemes, ICICI's fund has the lowest modified duration of 0.94 years. This means it has a lower interest rate risk. In contrast, funds by HDFC and SBI have a modified duration of 4.3 and 5.25 respectively. Now, these numbers are higher than the category average, so they have high interest rate risk. Now, we looked at the average maturity. It tells us the fund manager's view on interest rates. If the average maturity is higher, the fund manager expects a fall in interest rates. Now, ICICI's average maturity period is 2.43 years. On the other hand, HDFC's average maturity period stands at 6.27 years and SBI's average maturity period stands at 8.87 years. Now, what does this mean? Well, ICICI is not taking a call on interest rate movement. HDFC and SBI, on the other hand, expect interest rates to fall. A higher maturity will help them make better returns if RBI lowers policy rates. Alright, let's summarize all our findings. We feel that SBI Equity Hybrid is riskier than the other two funds. It has a higher credit and interest rate risk. HDFC Hybrid Equity Fund has a low credit risk, but its interest rate risk is high due to its higher modified duration. ICICI's interest rate risk is low, but its credit risk is slightly higher due to its investment in AA rated securities. Now, let's look at the performance of these schemes. To analyze the performance, we compared the schemes with Nifty 50 and the average returns of all aggressive hybrid funds. Now, to make this analysis even more thorough, we have also compared the performance of aggressive hybrid category with balanced advantage funds. Now, we did this because balanced advantage funds are also a good option if you wish to invest in hybrid mutual funds. Now, we've done a detailed video on this category. If you are interested in those funds, you can check out that video too. I have attached the link in the description below. Now, we looked at the trailing returns of 1, 3, 5 and 10-year period. The first observation from this data was surprising. The category average of aggressive hybrid funds performed better than Nifty 50 in all time frames. They have also fared better than balanced advantage funds. Next, we specifically looked at the 3 aggressive hybrid funds. Now, apart from the ICICI Prudential Equity and Debt Fund, the other 2 funds have underperformed the category average in most time frames. ICICI not only outperformed the category average, but the margin of outperformance was also huge. So based on trailing returns, ICICI fund has done better than the other 2 funds. This was different from what we expected. In the previous section, we saw that ICICI is heavy on large caps, while the other 2 funds have good mid and small cap allocations. So we expected higher returns from the other 2 funds than from ICICI Prudential Equity and Debt Fund. Next, let's examine their annual returns since 2013 to see how well they performed year on year. First, we looked at the performance of the aggressive hybrid category vis-a-vis Nifty 50 and balanced advantage funds. The aggressive hybrid category generated better returns than Nifty 50 in 6 out of 12 periods. Balanced advantage funds, on the other hand, did better than Nifty 50 in only 2 out of the 12 periods. So aggressive hybrid funds have done better than balanced advantage funds. Alright, let's now talk about the 3 funds we are comparing in this video. HDFC Hybrid Equity did better than its category average in 3 out of 12 periods. ICICI Prudential Equity and Debt Fund did better in 8 out of 12 periods. Lastly, the performance of SBI Equity Hybrid Fund was better in 6 out of 12 periods. Now we notice something very interesting here about SBI. Between 2013 and 2019, the fund performed better than the category average in 6 out of 7 periods. However, since 2020, it has been underperforming the category average. Now, SBI's recent underperformance is pulling down its overall long-term performance. However, the findings from this data are broadly similar to what we saw in trailing returns. Lastly, to examine the consistency of returns, we looked at the 5-year rolling returns of the schemes between 1st April 2013 and 15 September 2024. The average rolling returns of this category outperformed both Nifty 50 and balanced advantage funds. Now, this was surprising because we did not expect a portfolio with asset allocation to outperform a pure equity benchmark. However, it's possible that asset allocation and periodic rebalancing has helped these funds to generate better returns. Now, if you don't know how asset allocation with rebalancing can help you optimize your returns and downside, then I recommend you watch this video. Next, let's look at the rolling returns of the 3 funds that we have shortlisted. The average returns of both ICICI and SBI aggressive hybrid funds are better than their category averages. HDFC has underperformed the category average. We think it's essential to examine the minimum returns in these funds. After all, they are meant to protect the downside. Now, SBI has done the best here and ICICI has underperformed the category average returns. However, the difference is not significant. HDFC too underperformed the category average. However, in this case, the difference is significant. Alright, now let's dig deeper into the downside protection. We looked at the periods when Nifty 50 TRI corrected more than 10% since 2013. There were 5 such instances. We evaluated the performance of schemes during those periods. Now, if we look at ICICI, it did better in 3 out of 5 periods. SBI did better in 4 and HDFC did better in only 1 period. So from a downside protection point of view, SBI definitely has a better downside protection than the other 2 funds. ICICI ranks second here and HDFC ranks last. But what about the fund's performance when markets rally? Do they manage to do as well as Nifty or better? Let's check that. For this, we looked at the upside capture ratio. This parameter will tell us if the fund generated better returns during periods when the markets rallied. Now, since 2013, we have found 20 periods in which the Nifty 50 generated 10% plus returns. Now, if you look at the performance of the aggressive hybrid category, it generated better returns in 6 out of those 20 periods. But what about these 3 funds we are analyzing? HDFC generated better returns than the aggressive hybrid category in 7 out of 20 periods. ICICI had a better upside in 10 periods and SBI generated better returns in 8. So from an upside perspective, ICICI has done the best. Its downside protection is better than that of the category and its upside is also better 50% of the times. Now this lower downside and a higher upside have consistently helped the fund generate better returns than the category. If we look at SBI, it has the best downside protection of all 3 funds. Its upside capture ratio is also decent. However, post 2018, its upside capture ratio has deteriorated. This is something we covered in the earlier section as well. Alright, let's summarize our analysis so far. HDFC has an aggressive investment style in its equity allocation. Out of the 3, it has high, mid and small cap allocation and its portfolio is relatively concentrated. Further, its performance is not very impressive. In most instances, it has underperformed the category benchmark. SBI, like HDFC, is also aggressive. Despite this, the fund has good long-term returns and downside protection. However, in recent periods, the fund's performance has deteriorated. Of the 3 funds, ICICI has the best performance. Its investment style is relatively conservative due to a well-diversified portfolio and a high large cap allocation. And if we talk about its returns, it has outperformed the category average in most periods. Further, it also has decent downside protection. And with this, we have come to the end of this video. I hope you found this analysis useful. And if you did, please share it with your friends and family. I'll be back soon with another video. Till then, take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.